the day Americans were forced to give up their gold in 1933. Congress passed the Emergency Banking Act on March 9, granting the president broad powers under the Trading with the Enemy Act of 1917. This set the stage for one of the most controversial actions in U.S. financial history. On April 5, 1933, just 1 month into his presidency, Franklin D. Roosevelt signed Executive Order 6102, titled Forbidding the Hoarding of Gold Coin, Gold Bullion, and Gold Certificates. It required all persons in the continental United States to deliver their gold to a Federal Reserve Bank or member bank by May 1, 1933. By virtue of the authority vested in me, all persons are required to deliver on or before May 1, 1933, all gold coin, gold bullion, and gold certificates, in exchange for $20.67 per troy ounce. Exceptions were narrow, up to $100 in gold coins per person for personal use, gold for industrial or artistic purposes, and rare collector coins. Penalties for violation were severe, up to a $10,000 fine and or 10 years in prison. The order aimed to stop hoarding, prevent gold drains, and allow the government to revalue gold later, effectively devaluing the dollar to stimulate the economy. Most Americans complied, turning in coins, bullion, and certificates. The government collected hundreds of tons of gold. But compliance wasn't universal. Many hid coins, especially rare ones. The famous 1933 double eagle became legendary partly because of this order. Reactions were mixed. In the depths of the Depression, many supported Roosevelt's bold actions as necessary for recovery. His fireside chats built trust. But others saw it as a betrayal of property rights and the promises of the gold standard. Some viewed it as immoral, a violation of contracts in the Gold Standard Act of 1900. Enforcement relied on banks, social pressure, and self-reporting. Large-scale non-compliance existed, but prosecutions were limited. By May 1, the surrender period ended. On April 20, Roosevelt formally suspended the gold standard for international transactions. In June, Congress nullified gold clauses in contracts. The U.S. was effectively off gold domestically and internationally. The immediate effects? The government boosted its gold reserves. The dollar depreciated, making the U.S. exports cheaper and helping end deflation. Combined with New Deal programs, it contributed to economic stabilization, though recovery was slow and uneven. Abandoning gold constraints allowed for a more flexible monetary policy. Historians still debate how much these gold policies helped. Countries that left gold earlier often recovered faster. But it came at the cost of eroding public trust. Gold ownership remained restricted for U.S. citizens until 1974, when President Ford lifted the ban. Long-term, it marked a major shift from hard money to fiat currency managed by the government and the Federal Reserve. Critics argue that it set dangerous precedents for greater state control over wealth. Supporters say it prevented total economic collapse. The 1933 double eagles that survived became some of the rarest and most valuable coins in the world. On that day in 1933, Americans were forced to give up their gold, not through armed seizure in most cases, but by law and national emergency. It was a pivotal moment when economic survival trumped traditional property rights. Today, as we navigate inflation, debt, and monetary policy, the story reminds us how fragile trust in money can be, and how governments, in crisis, can rewrite the rules. Gold once anchored the dollar. After 1933, faith in government took its place. The debate continues.